If your portfolio is bleeding red, listen up. Those losses are worth up to $3,000 a year off your regular income, plus every dollar of gains they cancel, but only if you claim them right. And there's a 61-day trap that quietly erases the whole deduction for investors who don't see it coming. Let's break down exactly how stock losses turn into tax savings, the trap to dodge, and the deadline that decides everything. First, the rule that surprises beginners. A loss on your screen is worth exactly nothing. The IRS doesn't care what your portfolio is down. It cares what you sold. A loss only becomes real, in tax language realized, the day you actually sell the position. Down 40% and still holding? No deduction. The sell button is what converts pain into paperwork that pays. Now, what a realized loss actually does. 3 jobs, in order. Job 1. It cancels your capital gains, dollar for dollar, with no limit. A $50,000 loss can erase a $50,000 gain entirely. Job 2. Lost more than you gained. Up to $3,000 of the extra comes off your ordinary income, your paycheck. This year, $1,500 if married filing separately. And that's the rule for tax year 2025, same as it's been for decades. Job 3. Whatever's still left carries forward to next year, and the year after, until it's used up. Nothing evaporates. And here's where all of it lands. This is the real Schedule D, capital gains and losses, the form where every sale you made all year nets out into one number. Your individual trades get listed on Form 8949. They roll up here, and the bottom line of this form either adds to your income or subtracts from it. This one page is why a bad December sell-off can shrink an April tax bill. Let's say this year you took $8,000 of gains on your winners, and you're sitting on $12,000 of losses in positions you no longer believe in. Sell the losers. The $12,000 cancels the $8,000. Your gains are now tax-free. The leftover $4,000, $3,000 comes straight off your wages this year, and the last $1,000 carries into next year automatically. One decision in December, 3 separate tax benefits. Now the trap, the one that erases deductions by the thousands every January. It's called the wash sale rule. Sell a stock at a loss, then buy the same stock, or anything substantially identical, within 30 days before or after the sale, and the IRS disallows the loss. Count it. 30 days back, the sale day, 30 days forward, a 61-day danger window. Sell on December 20th and buy back January 5th because it looked cheap. Your December deduction just vanished. 2 important softeners on that trap. First, a disallowed loss isn't destroyed. It gets added to the cost basis of the new shares you bought, so you'll get the benefit eventually when you finally sell for good. But eventually is the problem. If you were harvesting for this year's tax bill, the deferral defeats the whole point. Second, the escape routes are simple. Wait 31 days to buy back in, or buy something similar but not substantially identical, so you stay invested without touching the tripwire. Next, the deadline that makes this a December conversation. Losses count in the year you sell. To use a loss against this year's gains and this year's wages, the sale has to settle by December 31st. Every year, investors do the math in February, during tax season, and discover the move they needed was due 10 weeks earlier. Put a note in your calendar for the first week of December. Review the losers. Decide on purpose. One more thing to know. Your broker is reporting all of this. Every sale generates a Form 1099-B to you and the IRS. Proceeds, dates, and in many cases your cost basis, and even wash sales inside the same account, already flagged. So your Form 8949 needs to match their paperwork. Where brokers can't see wash sales, across different accounts, sell in your brokerage, rebuy in another account, and it's still a wash sale, and it's still your job to report it. That includes your spouse's account. Quick word on crypto, since half of you are wondering. Crypto losses follow the same 3 jobs. Cancel gains, $3,000 a year, carry forward. We covered that in the Crypto Basics video. But the wash sale rule technically applies to stock or securities, and crypto plays by different rules there. That difference is a whole video of its own. The wash sale deep dive is next in this series. For today, stocks and funds, the 61-day window is law. Your action list. 1. First week of December, list every position that's down and that you no longer want. Sell the ones you're done with on purpose. 2. Mark 61 days around every lost sale. No rebuying the same thing in any of your accounts. 3. Match your Form 8949 to every 1099-B in February. And 4. If you carry losses forward, Keep last year's Schedule D with this year's documents. That carry-forward number is money. Quick recap. Paper losses pay nothing. Selling makes them real. Realized losses cancel gains without limit. Then take up to $3,000 a year off your wages, and the rest carries forward. The wash sale rule disallows the loss if you rebuy the same or substantially identical investment within 30 days either side, 61 days total, though the loss folds into your new basis. Losses count in the year you sell, so the deadline is December 31st. And the broker's 1099-B means the IRS already has the numbers. One quick note on who makes this. The tax breakdown is prepared by a tax accountant with over 15 years of public accounting experience, and every rule in this video is checked against the IRS's own topic pages in Publication 550. Educational always. Advice for your specific situation, never. Bottom line. In investing, losses are tuition, but the tax code gives you a partial refund on that tuition every single year if you file for it. Sell with intention, respect the 61 days, hit the December deadline, and a rough year gets measurably less rough. Next up in this series, the wash sale rule deep dive, including where crypto fits. This is general education, not advice for your situation. An investment decision should never be only a tax decision, so talk to a pro. Subscribe to the tax breakdown for taxes in plain English before you file, not after you overpay.